Hello, I'm Hickey from interest.co.nz and welcome to our monthly look at the precious metals markets with Mike O'Kane from NZ Mint. Mike, the last few weeks has been extraordinary in the world of particularly gold and silver. What went on in the last week or so where we saw gold drop off its highs and silver frankly crash?
Well, there's been a lot of talk about commodities being in a bubble, particularly gold and silver, precious metals. What we saw was gold reach another nominal high, 1575 at the beginning of last week, US dollars obviously, and over the last 2 days of the week, Thursday, Friday, dropped down to, we reached a bottom of 1475, so that's $100 off in about a week. Silver, we reached pretty much $49 US an ounce. Again, not quite a nominal high, but getting close.
Now that's back to the 1980 level when the Bunker Hunt brothers were in action.
Yeah, so we're talking 30 plus years. Now that's dropped back down to about $36 an ounce. As a speculative tool, silver has been talked about as being in a bit of a bubble for a little while now. We're talking going back to sort of December, November, where the prices essentially doubled in a short period of time. A lot of those pullbacks have come from an overall commodities pullback in the last week. So we've seen oil drop by 10%, corn, copper, you name it, across the board commodities pull back. We saw the US dollar pick up again. So you've got stronger US sentiment, which means people pull out of the more speculative items. With gold, there's a little bit of talk around the traps that essentially the central banks have been buying again. So we've seen Mexico increase its holdings by nearly 100 tonnes in the last month. Bolivia, for example, up 7 tonnes. So
why would they be buying gold?
Same reason most of the central banks are. They're not that comfortable with the long-term outlook of the US dollar. So essentially, you've got to come up with something to hedge your bets. Gold seems to be, for want of a better word, the optimal choice at the moment, or the choice du jour. And we've been seeing for the last year at least the European banks have been buying, the Chinese, gold as a reserve asset. And it's obviously starting to move into the Latin American central banks as well.
What are we seeing on supply with gold?
Well, at the moment we're getting about 5 tonnes of gold into the market every day. Now that's been absorbed quite nicely. Mexico's a prime example, 100 tonnes in just over a month and a half. That's easily absorbed. But what one of the speculations is that late last week there was a little bit extra came into the market, so another 5 to 10 tonnes at the market. Given the ability to absorb that sort of a volume in such a short period of time, we may have seen some stop loss positions hit in the US and we saw essentially the price drop in the US market time frame. The London market kicked in and the price stopped falling, and we actually saw a pickup of about $20 thereabouts US. So we hit 14.75 towards the close of the US market, back up to 14.90, close of the Euro market. Well, it's kind of, people are picking that what's happening is you're getting a move again of the gold from the Americans to everywhere else. Silver, it's probably a little bit more because it's been such a hot item for so long. It was due for some sort of a correction. But also the CME, the derivatives exchange, have changed their margin requirements. Now, in 2010, they changed their margin requirements to buy silver 5 times, up 4, down 1. Since April 25th, well, as of tonight, they will have changed it 3 times, increasing the requirement to hold a position of silver, which is 5,000 ounces, by 84%, which is a fairly hefty increase.
Why would they do that?
A lot of it's to try and control the speculative buying of silver. So again, we're harking back to the 80s with the Bunker Hunt brothers, trying to manage the open speculation so that there's a little bit more control in the market to stop the wildfire buying and selling going on. Essentially, they've increased it, so now if you wanted to buy 5,000 ounce position, you're looking at about 170,000, 180,000 US dollars for the total position. You now have to have a deposit of at least $26,000 to $30,000 to buy that. A lot of people can't afford that. They just sold their positions or what positions they had open, and you end up with wholesale selling, which again stop loss triggering, and you end up with a decrease in price of about $12 in 2 days.
Sounds like there were a lot of smaller players therefore in that market.
Yeah, in the derivatives market, you get everything from the George Soroses, who, as most people are aware of, has pulled out of a couple of positions in precious metals over the last 2 months, all the way through to not quite mum and dad investors, but smaller investors who are buying one position and speculating using that. They're probably more the size that have gotten out because they couldn't afford the margin requirement more than the larger investors.
Now, on the gold supply front, are there new supplies coming on from anywhere?
Well, given we've had growth over the last sort of 8 to 10 years, there's a lot of mines that have been coming online recently from areas as diverse as Western Africa all the way through to Asia. The Chinese have been supplying themselves, obviously. It's a lot of the mines that people were kicking in or starting to look at doing over the last 5 years, just starting to turn over a little bit of profit.
Because I can imagine with the gold price at $1,500 an ounce, that makes the economics of gold production better for some.
Oh, definitely. 5 years ago when I started, it was approximately $350 an ounce to mine an ounce of gold. Gives you your base value of gold. If it's lower than that, no one's going to mine it, and you're going to stop your supply. What's happened is the last sort of 5 years we've seen the price of oil over $100, wages, risk factors, the locations a lot of people are mining gold aren't the optimal, and now it's estimated that the price to mine an ounce of gold is about $900 US. So the higher the price get, obviously the more return there is to the mines, so that the demand to create new mines is obviously increasing as well.
So over the next month, what are people in the precious metals markets looking at?
Key word, I think, for the next month at least is going to be volatility. We're coming into the Northern Hemisphere summer season, which is normally, I like to call it the doldrums. We see a lot more sort of quiet periods where there's not so much trading done. But given the factors that are driving the price at the moment and what we've just seen in the last couple of days at least, until we see a nice long period of stability, i.e. the price hasn't increased or decreased significantly over a period of time, the general consensus is it's going to be quite volatile for a while.
And the two big things on the horizon, the European financial market problems with the Greek, Irish, Portuguese...
the pigs,
The pigs. And secondly, the Federal Reserve due to finish money printing June the 30th.
Yeah, so quantitative easing too finishes in June. Who knows what happens after that? Well, there's a lot of speculation that quantitative easing 3 or a version of it, because they've already announced they don't want to do a third iteration. So maybe there's a variation on a theme going on, but the expectation again is it's probably going to be inflationary, and historically that's been good for precious metals.
Mike O'Kane, the head of Bullion there at NZ Mint, with our monthly review and outlook of precious metals. I'm Bernard Hickey for interest.co.nz.